When someone mentions investing, they generally mean one of two things. The first is the stock market and the second is property. Everyone wants to be the next great property investor, but realistically, most of us don't have the time or effort to find properties, do the repairs, rent them out, and take on all of the risk. That being said, we know we need to diversify our investments and not have all of our eggs in one basket. Property can be a great way to do so. Well, what if I told you you can invest in property and receive rental income tax-free, without the risks that come with owning the physical property?
This sounds too good to be true, I thought.
And that's where today's topic comes in: REITs, real estate investment trusts. You've probably heard the term floating around in the world of investing and wondered if there's something that's worth investing in. Well, today we're going to dive into the world of REITs, explain what they are, how they work, the costs, expected returns, and help you work out if they're a good investment for you. So first up, what actually is a REIT? And you're probably gonna hear me pronounce that wrong, so do bear with me. On the 14th of September 1960, President Dwight D. Eisenhower signed legislation that created a new approach to income-producing real estate investment. The president's goal was to open up investment opportunities to regular Americans, allowing them to invest in large-scale, high-quality, and professionally managed real estate that produced an income, which had previously only been possible for finance professionals or the wealthy. The groundwork for the modern REIT era followed with the tax reform of 1986, when REITs were given the ability to operate and manage real estate rather than simply owning it or financing it. The approach has been refined in the ensuing years. More than 22 countries followed America, opening REITs, including France, Spain, and the UK in 2007. The way a REIT works is simple. Investors buy the REIT. That money is used to buy property, both commercial and residential. This can range from shopping centres, factories and warehouses to even hotels and apartments. The tenants pay rent and income is generated. This is a really attractive model for them, as they don't have to pay corporation tax on the profits. It is very important to note that when you become a shareholder in a REIT, you pay income tax, not dividend tax on the distributions. The idea behind this is that you are taxed as if you were to own the property yourself. So if you own a REIT, it's important that it's in a tax shelter, like an ISA or a SIPP. This way, there will be no tax to be paid on the distributions, making them a very tax efficient way for you to invest in property. Because REITs are structured so tax efficiently, almost all investment companies that invest directly in UK property have decided to use the REIT structure. Another way to think of a REIT is like a mutual fund, but rather than them investing in stocks, they invest in properties. They allow you to invest in a group of properties through one single investment. The entire trust is managed by a large-scale ETF provider that will invest on your behalf. Now you might think, whoa, hold on a minute. If I own a property, I benefit from the price going up. Well, you do with a REIT too. You benefit from the price appreciation and the rental income, without needing a huge sum of money to do so. There's over 50 REITs listed on the London Stock Exchange with a combined value of over 54 billion. So where do you start? First, you need to understand the type of REITs. REITs can be split into two categories based on what they invest in. The first is equity REITs. These are funds that own physical properties and rent them to businesses or individuals. The income is paid to the shareholders in the form of dividends. Typically, these will include companies involved in residential, commercial, or hospitality. The second is mortgage REITs. These are funds that buy mortgages or mortgages backed by securities. They earn income from the interest on the mortgages that they invest in. While these two are the most common, you will also find specific REITs that invest in types of property, such as healthcare, which invest in hospitals, doctors' offices, and care homes. You've got residential REITs, which is student housing, apartment blocks, and family homes. There's retail REITs, which is grocery stores and shopping centres, industrial REITs, which are warehouses and distribution centres. There's office REITs, which is skyscrapers, business parks and government buildings, and even infrastructure REITs, which can include telecommunication towers and energy pipelines. The easiest way to think of it is like having an ETF that gives you a coverage of a specific market. You'll be buying the fund as you would an ETF anyway, which will give you the ability to invest small amounts and sell it when you want. A REIT is best when committed to the long term, but if you need access to the cash, the beauty of a REIT is that you can still sell it. You can sell a REIT at any time for the current share price, which is derived from the NAV. The NAV may not be a term that you're familiar with unless you invest in mutual funds regularly. NAV stands for net asset value, which is the value of everything contained in the fund minus any outstanding payments or debts. So let's say a REIT holds 200 million in property but has 50 million in mortgage debts. The total NAV is 150 million. It's essential to understand the NAV of a REIT in order to track how it's performing. Now, before we go any further, it's important for me to highlight the potential risks of REITs as well as the benefits. There's three main risks to be aware of. Your money is in someone else's hands. With a stock, you get a say where the money goes. With a REIT, you don't. Although there is the argument here that you're using someone else's judgment rather than trying to learn property investing yourself. There's also regional housing markets, and they have their individual price fluctuations that need to be factored in because these will affect your investment depending on where your investments are based. And perhaps the most significant risk is that REITs are subject to economic disruptions. A prime example of this is when during the COVID pandemic, healthcare REITs boomed while retail REITs suffered. Now, let's look at the benefits. The REIT is required to distribute 90% of the profits they make from the rental to the shareholders. They're often classed as consistent dividend payers. You earn a passive income from them in terms of payouts. Some can pay monthly. They can also make investing in foreign property more accessible if that's something you're interested in. You also don't need any property experience to own them. And there's a low barrier to entry in terms of how much you need to invest. So now you know the pros and cons, let's talk about buying one. Because investors are spoiled for choice when it comes to choosing a REIT. This will depend on your individual risk profile and the type of market you want access to. It's important that you choose the right REIT for your individual needs. Some people may want a UK REIT investing in UK real estate. Others might want one which meets certain environmental, social and corporate governance, while others may choose to invest in overseas property. For example, the UK-based Centre for Economics and Business Research said recently that as a result of China's response to the COVID-19 pandemic, its economy will overtake the US by 2028, 5 years earlier than previously forecast. They also stated that within the next decade, China's REIT market will dwarf the US, which currently has near 200 REITs. China as a country is still vast and has a growing wealth gap. There's a huge opportunity for the C REIT as it matures to deliver returns for investors. The other option, which may feel more familiar with ETF investors, is to go for a REIT ETF. This way, you can have a highly diversified portfolio rather than relying on the performance of just one or two REIT stocks. An example of a standard REIT would be the Edison Property Investment Company, or EPIC, the best ticker ever. Now, an example of a REIT ETF would be the iShares UK Property ETF. This is one of the few UK REIT ETFs which seeks to track the performance of an index composed of the UK listed real estate companies and REITs including popular REIT stocks like Sergo, Land and Securities Group. Personally, I think it's probably better to have a specific sector in mind and just pick a REIT, or a REIT ETF which focuses on that. But I'd be more inclined to go for a specific REIT. The reason for this is that although I do think REITs are a good way to invest in property and diversify your income, they pay some fantastic dividends. But you still, in my opinion, like dividend stocks, need to know the direction of the company. Because a 5 or 10% dividend is fantastic as long as a REIT doesn't drop 20% in value, just like dividend stocks. But if you can pick the right high-paying dividend REIT which also grows, then you're on to a winner. I'm personally looking more into REITs more and more because I find them so interesting. Let me know if you'd like me to cover more on them and if you own any down below. Thank you guys for watching and I will see you in the next video.